Hey, welcome back. My name is Joshua Bellinger of CounterVest, and I have an interesting trade that I'm going to share with you on selling a put, how to manage it, and walk away here. So, we're going to cover some interesting topics. And one of the things to keep in mind is that it's just not advantageous just to sell puts just because of it, but we're going to walk through the thesis, trade structure, and managing that risk. So, let's take a look here at DD Global. This is a recent IPO at $18, and it's trading at 7. This one's had some issues here, but a couple things to keep in mind. Recently, this had sold off here a couple days after it IPO'd because of some regulation tightening over in China. That's the risk with these ADRs. That's the risk with Chinese stocks in general. There's just a lot of shenanigans. It doesn't mean there's opportunities to trade. It just means they're not good investments. So DD's the Google, or not the Google, but the Uber of China comparison, if you want to compare one to the other. But this has been beaten down. Back after this happened here, I did sell puts in this in the August 6, 10 and a halfs. Sold them for about $1. I was able to buy them back at 50 cents, I think, right here on the 14th here. So we're going to look at doing something similar here. Now, selling puts just to sell puts is not necessarily the best the best situation. It doesn't make any sense. I mean, because you could have said, here's a good example of some recent ones of some crackdowns from China. This EDU has gone from 19 to $1.94. Some individuals, and I imagine some, were selling puts in here and thinking that this was not going to go to zero, that we're going to get a bounce here. Well, when you start to deal with governments outside the United States or government types of issues, those are the kind of things you want to stay away from. But when I look at Didi, for for them to outlaw an Uber, I mean, I don't see it there. But again, it's always understanding risk, how to manage it, and what the risks are. So short term, I've been seeing some call buying here. That doesn't necessarily mean that it's bullish because they could be short shares and buying calls to hedge that position. It's just how to position that. So one of the things I'm looking at here is on the September 38 contract here. What I would be looking to do here is possibly, we look here, it's a $3.50 move priced in each way, higher or lower. So if pricing something go below $5 here, there is some risk there. But one of the things that sticks out here, selling a 6.5 put. One of the other things as well, we saw some puts selling in some of these contracts here. So the 7 here doesn't necessarily mean that they're selling to open or selling because they're selling premium here. But what the thesis is that we just get a bounce here. It's hard to borrow. What news can come out from this is that they completely ban it, and that's the risk, right? But when we sell a product such as this at an $8 price, it's advantageous for smaller accounts. So the implied volatility on this is elevated, and it's not really discovered. So what I'm thinking is it is overpriced on this. And one of the ones I would be looking at is the 6.5 put here at 90 cents. The overall return on capital is 90%. That's using margin. What I would be looking to do, though, is selling at 90, buying at 45. Selling at 90, buying at 40. Selling at 90, buying at 50 cents. These are trades that you don't want to stay in, because if I stood in my one put trade that expired in August 6th, that I sold for $1, those are trading at $3. So it's always about managing risk. That's how we look at it. That's what we do. Let me know what you think and leave a comment below. We'll see you in the next video.